When I started in my very first day of accounting, I was told everything has a debit and a credit. So for every debit, there's a corresponding credit. So you debit assets and expenses, and you credit income and liabilities. For example, if you have a sale, you credit income and you debit your bank as the money comes in. So it's very simple. Just make sure you have two transactions for everything that happens. Your profit and loss is your like day-to-day activities, so your income and your overheads. While your balance sheet will be your more longer term things, so like your premises, your bank, or the people you owe money to, like loan or debt or whatever it is that you actually owe money to the tax man or whatever it is. And the profit and loss on the balance sheet really are just those things, all listed out in their separate categories. Now, you can see a complicated profit and loss and it'll make your eyes bleed, but as a startup, they should be pretty simple because there isn't that many things happening. Something that's super important outside of profit and loss and balance sheet for a startup would be a cash flow. Because cash is what's going to keep your business alive. So you want to show how much cash we have today, what are we going to spend in the next month, what income we're going to have, and how much cash will we have at the end of the month. That's a very simple little thing to do. You can do it in a little Excel spreadsheet each month, and just add the next month next to it and move the cash up the top. And just practice what you think is going to happen and stick in what actually happens. And what did you learn from being wrong? You, as the CEO or as a founding member, should understand the decisions that you make and the financial impact that those decisions have. And, good or bad. And things that, you need to get that piece of equipment for 20 grand and it's going to, it's great. Like everyone wants nice things. But as the CEO, you're going to have to make difficult decisions. And there's some nice things you can't have, and there's some nice things that you need. But things that you spend money on are all going to have an impact on the success of your company or otherwise. And you need to understand that impact. And you need to be able to make decisions while you understand that. Everything, hiring somebody new, okay, are they going to generate more money than they're costing? Are they going to add value to this business? Renting that new office. Okay, how much is that going to cost us? And what are we actually going to achieve by moving there? Everything every simple little decision you make is probably having a financial impact on your company. And you need to understand what that impact is and what it does to the future success of your company. And learning it now, when it's a simple piece of paper and a biro or a one-page spreadsheet, is the easiest time to learn it because it will scale as your knowledge develops. And then, hopefully in 5 years or in 3 years or whenever it is you have enough money to hire an actual in-house financial specialist, well, then you will understand it too. So when that person comes and talks to you, you understand what they're talking about.
A good venture capitalist should be able to look at a statement, see it broken up by month or by quarter, and see and identify problems in the business or ask questions. I mean, it's extraordinarily, and the same thing for a good CEO. They should be able to look at a financial statement and see that there's something really wrong in this part, or there's an error. I can't tell you how many times I've looked at a financial statement and say, what went on in April here? And I said, oh, well, you should have capitalized that expense. Or, well, then, like there are errors that will just pop out that tell me that the people aren't managing their business in a way that like everyone starts not knowing everything, right? So it's okay that you don't know these things, but by having good financial statements, you can keep getting better at it all the time.
So you can start with a blank piece of paper and you can do it. The easier you keep it, the easier it is. And like, say, I often see startups and they come into me with their financial projection model and there's 72 tabs on an Excel spreadsheet, working forward for 5 years and about three questions, their cousin, Billy is an Excel whiz and he helped them through it together. And when, three questions in, they're floundering furiously. Because it's all linked together with formulas and something changes and the whole thing goes to pot and they're not sure what happened. So like starting with a blank piece of paper and just looking forward to next month is a good start. And saying, okay, what do we think we're going to spend next month? And what income do we think we're going to have, if any? And even then saying, okay, what are we going to spend our money on? Okay, we're going to have a salary, we might have rent or whatever it is that we're going to spend our money on. And you'll start at the top with, this is how much money we have in the bank. This is how much we think we're going to spend in the month. This is how much we think will come in the month. And this is how much money we think we'll have at the end of the month. And then at the end of the month, you sit down and you look at how wrong you were, or what you got right. And you say, okay, well, now let's do next month because we've learned from last month. And there you go. You're beginning to change your budget and change your forecast and actually develop a competency around doing your financials. And you're also being able to say, okay, this is our cash position. And if we keep going at this basis without any income, well, then we're going to be, out of here in 4 months or so, or we're going to be out of here in a year, or whatever we think our runway is going to last us. And just practicing it. And at the end of the month, sit down as a team and talk through it and say, okay, this is what we projected we were going to spend. This is what we spent. And this is why we got that wrong. So we'll change next month, and this is what we think we're going to do next month. And then when you look at what you're actually spending, you can say, okay, again, very, very simple, but what objective is this spend achieving? And what do we want this spend to achieve? Especially for like somewhat discretionary spend, like an advertising campaign, or if you buy a piece of equipment or something that you spend money on that you think is going to add value and that you think is going to generate something positive for the company. Well, then actually look at it and say, did that achieve what we wanted it to achieve? And if it didn't, well, then stop it, or then say, okay, well, this isn't working, so let's do something else. And actually having those types of discussions as a founding team is what's going to make you develop and actually spend your money properly and achieve better goals.
I would start with actually you doing it on your own personal finances. In the United States, there's a product called Quicken, and it's a way for you to keep track of your checkbook. And whenever I guess people don't do checks these days, but if you did do checks, it tells you where you're spending your money, and all your electronic transfers are automatically categorized, and you can see how much of your money you're spending on rent, or spending on entertainment, or spending on food, or etc. When you have that control over your own personal finances, and you are able to look at what cash flow statements look like, and look like what budgets look like, and look at your P&L, profit and loss statements, Quicken does that in a really friendly way. QuickBooks is their commercial equivalent, which is definitely available all over the world. And that's the first, by diving in and doing is the best way to really master that. Doing it on spreadsheets is not going to be sustainable for any long period of time, but it also doesn't give you the framework of really understanding how all these statements work. And it all just sort of pops up. All you really have to do is keep track of your expenses and then categorize them well, and then using the right software, all those forms get filled out really well. It's just a matter of keeping track of your expenses and any income that you have. most startups, maybe they will actually keep a shoebox where they throw in their receipts or their digital receipts or whatever, but they don't do anything with it. So they have no idea of what their actual burn rate is, how much money they're going through, and they have no idea of, you know, what the runway is. Runway being the length of time that they would have before they run out of money. And so you can tell if you've got a bad entrepreneur if they're not producing monthly statements as to what their actual you know, financial situation is. You have to keep on top of that. Clearly you have to keep on top of it if you have any staff, because you've got to pay salaries, et cetera. But even without that, you have to keep on top of it just to know, you know, how long you have before you need to go out and raise money. The last thing that any entrepreneur, any backer of any entrepreneur, any angel or anyone else wants to hear is, oh, I ran out of money. I need to make payroll, you know, on Thursday. Can you, you know, invest another $30,000 into our startup so we can make payroll? Because that lack of preparation tells you don't have a person who's trying to run a business. They're trying to run, you know, I don't know, maybe they're trying to make a difference in the world, but they don't know how to run a business. And ultimately, investors do need to, you know, have the right expectation of being able to actually get a return on it by actually having the thing that they're investing in be actual business rather than a technology development program or anything else. So the founding team, you know, which is often the CEO will actually take the responsibility of actually keeping those financials because there's no one else in the company to do it as you're getting started. And so even if the CEO is also the chief programmer or one of the lead technical people in the firm, they also have to take that responsibility on. I think after you hit a million or so in revenue, you definitely need it. While you're still doing, you know, one-off contracts or whatever, you know, I mean, after you have 10 staff, you know, you definitely are going to want to probably maybe have somebody come on, you know, with that responsibility as one of their lead responsibilities. Maybe they also manage the office. Maybe they also do some other administrative things. But it doesn't need to be the first, you know, in the first 10 staff, I'd say. And then you can always use like an outsourced accounting person to do the annual statements. But frankly, you know, you don't necessarily need that. QuickBooks does it all automatically for you. So, you know, you can get by for quite a while without, you know, without requiring a full-time person. And well, you know, for a very long time, you can get by without a full-time person doing it as their full-time role. Normally it's a part role for a person, even at a 10-person company or 20-person company. You really need to know this stuff. Some people will outsource it at the earliest stages, but I'm not sure how productive it is to do that. People would benefit by actually using these tools and setting up a proper chart of accounts as well in-house. So if you outsource it, you're not going to be getting the information in the structure where it's most useful. For example, like if you outsource it to an accountancy firm, or you know, like a you know, just an accountant, they will probably just give you some quote unquote chart of accounts, which is just the listing of the different categories of your expenses or your listing of the different categories of your income you know, levels. And they won't break it up into things which are useful for you to manage the business. Like they won't break it up necessarily into the salary. They may have one line item for all salaries rather than the salaries in the R&D, rather than, you know, versus the salaries in operations or production or marketing or any other marketing and sales, the other divisions they may have. So it's important to actually have your financial statements be readable in a way which is useful to you in managing your business.
An example I give is one of our portfolio companies raised about €3.5 million, and they ran out of money a couple of years ago. And we spent a week in their office looking down through their financials and saying, okay, they had maybe 30 employees, 35 employees. No, they didn't have an in-house financial person. They outsourced it to an accounting firm that they paid like $3,000 a month to. The accounting firm produced this beautiful embossed pack that nobody ever read, but it looked really nice, and there was lovely little graphs in it and everything. And it got handed out at the board meetings. The CEO never read it. I don't think any of the COO maybe had a look. I don't know. But when they ran out of money, and when you sat down with them for a week in the office and you said, okay, let's break out the bank statements. And then you go down through each item and say, what's that for? And they're like, oh, are we still paying for that? I thought we stopped that. And there's lots of that happens. And then, like, this is a company that, to all intents and purposes is successful, and is a big company. And then, like, we just really went back to the bare bones in the company and said, we will fund you, but we're going to do it on a kind of tranche basis based on you getting your house in order. Let's cancel the $3,000 a month that you're giving to the accounting firm, and let's just hire an accountant in here for the same money. And they can actually talk to you every day about decisions you're making and what the financial impact of that is. And they'll do, like, I'm sure the accountant will say, oh yeah, you're doing a great job. Yeah, here's our invoice. While the actual person who works for you is going to say, oh no, wait a second, no, we need to stop that because I'll be out of a job if we do that. They're a bit more invested in your success. We looked at a lot of different things they were spending money on, and kind of, okay, what are the smart objectives of this spend? It's a very material spend in the company. And is anyone actually monitoring the spend? We really just did a deep dive on everything. What happened is they hit their milestones. We funded them over about 10-month period. And at the end of the 10 months, they had their very first profitable month, and the company sold for $26 million. So in terms of a sales funnel, it would be who you think you're going to sell your product to, where you're at in the process. Now, financial people mightn't be as deeply involved in that. They would be more, I guess, following up on it. But the people who are, like, where that will be important is articulating to the team and to your investors, like, what potential income you're going to create in the future, and where you are in terms of getting customers. So the hardest thing to do as a startup is to get somebody to give you money for your product, or to get a customer. So you need to convince somebody to pay for whatever it is you're selling. And then you need to take that and go to investors and say, okay, we have X amount of interested people who want to buy this wonderful product we have, and this is why they want to buy it. We can make it, and we've proved we can make it, and this is how much it costs to sell it or to make it. And this is the profit we're making on the product. These are our other costs. All we need is X amount of euros or dollars, and we're going to go away and become an exceptionally profitable business, and you will get your money back in 7 or 8 years tenfold. And that's what people come to SOSV and say to us every day of the week. And some of them, it's even true. So we like, where I see sales funnels a lot are in things like board packs, where you would see that, okay, here is our existing customer base. Here's how much they're paying. Ideally, it would be some sort of recurring revenues, that you can say, okay, that we have these people on the hook, happy customers making a profit, and like, the hardest thing to do is to get the customer. So when you have them, you want to keep them. and this is how we're keeping them. This is how we're, leveraging them even and getting more revenue out of them. This is the feedback they're giving us. But like what I see a lot is, especially because a lot of our companies aren't making a profit, is all of the potential customers that they are talking to and where they are in the process of them becoming a paying customer. So I see lots of different ways of presenting it. It's normally like a chart, and it will show, okay, customer A, we're at the introduction meeting or whatever, and then customer B, we're expecting to sign a contract next week, and then they show like the 5 or 6 steps that take you from one to the other, and how they've navigated them. Maybe if they have a sales team, which people are actually converting customers in, or potential customers into actual customers. So you can actually monitor the success of the sales team and ensure that people are actually capable of selling your product. And if people aren't, maybe redeploy them, or maybe it's not for them. And like that's normally where I would see a sales funnel. It's normally developed by the sales team and the CEO, and then the CEO would articulate about, this is how wonderfully successful we're going to be in the future once we convert all of these potential customers into paying customers.